Hi, it's Marco here. So is SoFi the best bank stock that you can actually invest now? Let's dive straight into it and compare it to the other banks. So first, let's have a look at what SoFi is like under the hood. So first of all, we look at EBITDA. Actually, more importantly, EBIT, which is a measure of the actual profitability. And so we see that straight off the bat, SoFi is not profitable. It's never been profitable, and for the foreseeable future, it doesn't look like it's gonna be profitable. Now, if you look at EBITDA, which is something a little bit more complicated, it also includes depreciation and appreciations, and in that case, it would look like it's profitable, but the truth is different, that at the time of recording, it's not profitable. And so the question then becomes, this company, why would you invest in it? I mean, we have looked at it and it's not profitable. So what are the modes of SoFi? Well, looking again at other data, we see that one of the best things of SoFi is that the number of members that have actually joined SoFi has grown exponentially. Look at this chart if it's not the best chart that we've ever seen. So you see that the growth is there. There is a lot of growth and a lot of customers that have been joining the company, and the growth year on year in terms of customer is just really there. 54%, 90%, and it just seems to be speeding up. Recently it's been like a bit maybe plateauing and not going as fast as more than 100%, but the growth is there. And so are we then looking at a company that is more of a growth story then? Is that what we have? Well, if you compare it to other banks, of course, JP Morgan and other banks, they are growing, yes, but they are already profitable. And so that's what the stock market sees. On one side, we have SoFi that is more of a promise and more of a company that is growing. On the other side, we have very established businesses that are growing, yes, but not as fast as SoFi. In fact, let's have a look at the reasons why SoFi is not profitable. There are reasons and they are affecting SoFi, and I guess because SoFi is more of a smaller business, they're affecting SoFi more. So for example, there is the ongoing federal student loan moratorium, and that is being extended up until August the 31st, 2022. And so that's kind of how banks work. They lend money, and in the case of this moratorium, the government has gone and said you cannot go and ask for the payments. So students are able to live freely without any debt until the end of the moratorium. That has been extended a couple of times now, and so we see that SoFi is potentially growing more as soon as we have this ban, let's call it ban, lifted. And it's something that if you are a SoFi investor, you should hope for. And so SoFi is not 100% profitable. We see that it's getting there, but not quite. And although their assets are appreciating, we see that it's not profitable. So what are we looking at here? Well, we have a company that has to survive with the amount of cash they have in the bank, and that's obviously a concern and something that we have to look at. So if you look at, for example, in their balance sheet, you see, sorry, it's not the balance sheet, it's the cash flow statement. Very important to know the difference. But the amount of cash at the end of the period is quite substantial. So we are looking at, and I'm actually covering myself, so I am going to move myself so that you can see what's going on there. So there you go, I moved myself. Wow. So as you can see, we do have quite a big amount of cash at the end of the period, and that's the latest earnings report. But what's very important to see is the dilution, and there's been a lot of dilution, especially in the previous quarter, not in the one that just passed, but the one before. We had a very big dilution, and that caused obviously the stock to go down, but most importantly for cash to be raised. And so that's the kind of company we have in front of us, a company that still needs to dilute the stock and that mostly trades at the time of recording on hype. And so is that the kind of company that you think would fit your investing style? That's kind of the question. So on one side you have Sofi, and they actually, you know, as I said, it's a lot of hype and it's growing a lot. On the other side we have JP Morgan and Bank of America. They are obviously well-established company and they are making shed load of money. They're growing, but not as fast. Last thing that is very important to look at, and this could be one thing that could make you change your mind on the whole SoFi, let's say, mode, etc., etc. Very important. So again, this is something that I really hope that is gonna get better as time goes by. So these are just the revenues, and these are the expenses for SG&A, so selling, general and admin expenses. Now if you look at both, you see that and just looking at the chart, as the revenues go up, we also see the SG&A go up. Let's look at this without even like touching the chart. We see that SG&A is basically just progressing and getting bigger and higher along with revenues, apart from in this specific quarter here that is a bit weird, but we can see that there is almost like a connection, some kind of trend here, which is what you have to deal with mostly with companies that are not profitable. And so SoFi is still a very, very speculative play, guys. Let's be totally clear on that. It's a company that if you buy now, although it has gone down a lot, over 50, even 60% from all-time high, it's a company that is very, very speculative. And so do not go all in, that's for certain, but it has a very big growth potential for the future. I'll be making more videos on SoFi. Thank you for watching, and I'll see you in my next video.